Good morning and welcome to today's Fridays with Vistage webinar. Before we begin, I'd like to go over some items to help you participate in today's webinar. If you are experiencing technical difficulties joining the webinar session, please dial GoToWebinar support at 888-259-8414. During the presentation, all participants will be in listen-only mode. To submit a written question at any time during the event, type your question in the Q&A panel at the bottom of your control panel and click Send. I would now like to introduce the moderator for today's webinar, Dave Nelson.
Welcome, members and guests, to the Fridays with Vistage webinar. I'm Dave Nelson, a 14-year member of a Vistage group in Pittsburgh, CE676, and your Vistage webinar host today. We're talking about transitioning ownership of your business with Holly Swan, Bob Kitzman, and Karen Reynolds-Sharkey. Holly, Bob, and Karen, welcome to the webinar.
We're thrilled to be here.
Let me give a brief introduction to each of you. So let's start with Holly. Holly Swan is a wealth strategies advisor at U.S. Trust, Bank of America Private Wealth Management. In this role, Holly works with high net worth individuals and their families on estate and income tax matters and charitable giving. Holly also enjoys educating younger generations on the privileges and responsibilities that come along with wealth. Bob Kitzman is a business transition specialist at U.S. Trust, Bank of America Private Wealth Management. In this role, Bob, or Robert, works with families to help evaluate the many paths associated with the maturation of a business within the context of their overall needs and wealth management plan. Karen Reynolds-Sharkey, who we're going to hear from first, is the National Business Owner Strategy Executive with U.S. Trust, Bank of America Private Wealth Management. Headquartered in New York City, Karen directs the bank's strategy, outreach, and offerings to entrepreneurs and their family members nationwide. She leads the bank's strategic vision and tactical initiatives for this fast-growing constituency, promoting an optimal client experience. If you have a question during our webinar, please go to the control panel and find the Q&A section, type it in. Now, we're not going to take them as we go, but we'll take as many as we can at the end of the presentation. So, Karen, let's get started talking about transitioning ownership of your business.
Okay, thank you, Dave. And like I said, we're thrilled to be here today. At U.S. Trust, we've been working with business owners for decades, helping them to build out their business, but also helping business owners to plan for the next chapter in their life. Whether that means you're transferring your business to your children or planning to sell your business to a third party. We know that many of you are laser focused on your businesses, managing day-to-day operations, hiring new employees, and overcoming the obstacles of growing a business. So we want to help make planning easier for you. It is estimated that close to 60% of business owners expect to exit their business over the next decade. And that decision is intensely personal and will impact not only you, but also your family, your management team, and your employees. At U.S. Trust, we conduct an annual survey of business owners, and we typically find that over 60% of business owners do not have an exit plan in place. And only about 50% of business owners have an estate plan prepared for their family. So our goal here today is very simple. We want you to be prepared, and we hope today's conversation will help to provide ideas and insights that will help you, your family, and your business. So now I would like to introduce my colleagues, Bob and Holly, who will be discussing how to get started or how to improve your existing plan, integrating business succession with your individual and family estate planning. And I think you will find the topics interesting. So over to you, Bob.
Thank you, Karen. And as you heard, there are a lot of business owners today thinking about when and how they will exit their company. And this is certainly understandable, given that more than 1 million closely held businesses today are owned by baby boomers. And baby boomers, naturally, are reaching that stage of their career that it's time to start looking at transitioning the ownership and the management of their companies. And so throughout this webinar, Holly and I will discuss a variety of both business and personal issues involved in succession planning. As you think about it, there are numerous intersections between an owner's exit strategy from the business and their personal estate plan. As to the business issues, discussions on business succession planning have often centered around topics like grooming the next CEO or devising that tax-efficient strategy for transferring ownership. And these topics are important, but I think the more perplexing issues really come out of taking a hard look at the future of the company, determining how you're going to retain key employees, how to provide for an effective transfer of control, and to ensure that the future leaders of the company are prepared to assume their new responsibilities. But the business issues, they're just part of the puzzle. There's also an equal number of challenging personal issues to consider. Holly, can I turn it to you?
Thanks, Bob. I think it's important for people to not think of this as planning for death, but to think of it as smart business planning that can and really should be done during life to minimize taxes. Some of the personal issues that we'll be discussing today are minimizing income and wealth transfer taxes to preserve wealth for future generations, addressing family legacy and charitable goals, considering alternative approaches to determine the inheritance of family members who might not be involved in the business, retaining sufficient assets or cash flow for the business owner to fund their desired lifestyle post-transition, and how they want to redeploy those assets in a manner that's consistent with their long-term goals. And sometimes that just means investing in the market. Sometimes that means starting a new company, something philanthropic. So we'll discuss all of those options. In order to get business owners to plan, they need to clearly understand the value of planning and the risks of failing to do so. A well-constructed plan will allow them to maximize the value through pre-sale due diligence, retain greater control, meaning management retention, transaction representation, and most importantly, selling when they want to sell. It will reduce execution time. Transitions take so much time and energy, and it can be really challenging to run a business while you're running a sale. It will help them to minimize risks, which means maintaining the quality of earnings, keeping a clean balance sheet and income statement, preventing things like litigation and other roadblocks that can help to limit the degree of escrows and warranties in the transaction. And it will help address specific business and personal goals. Bob, is there anything that you'd like to add here?
Yeah, I have a couple of thoughts. When thinking about the value of a succession plan, to me, a well-structured plan not only provides the benefits that you've outlined for the owner and his or her family, but I think it's also really a good part of a business plan. So in a strategic business plan coupled with a well-developed succession plan, I think can truly add value to the company. But I'd also like to suggest that when thinking about your customers and your suppliers, they will often take comfort in working with businesses that they know have a succession plan. This is particularly true when you're working with a family-owned business, as it'll give confidence to the overall stability of the company. So with that said, what do you say we look at some exit strategies?
Sure thing. There are many different forms of exit strategies, and the two primary categories are transfers within family and then sales or transfers to people outside of the family. So starting with transfers within the family, obviously transfers can be made by gift during a lifetime, and in all of these scenarios, valuation discounts could be used if they're appropriate. The easiest way to do this is through an outright gift, but this is actually really uncommon, even though it's obviously easy and a cost-effective option. The downside to this type of planning is that the owner doesn't retain control over the gifted assets. This also would obviously use all or a portion of the donor's inflation-adjusted $5 million estate and gift tax exemption. Another option is a grantor retained annuity trust, which we often hear referred to as a GRAT. This is a gift to a trust in exchange for an annuity. Generally, a GRAT would benefit the grantor's children. There's statutory support for this type of structure, and as a result of that, it's a very popular technique. Another option is a gift or a partial gift sale of a business to an intentionally defective grantor trust. Similar to a GRAT, but instead there is a sale to a trust in exchange for a promissory note. One big benefit of this type of transaction is that it can benefit the grantor's grandchildren as well as future generations. Both GRATs and defective grantor trust sales are structured to pass the income tax consequences through to the grantor or the creator of the trust. As a result, neither of these techniques carry with them any income tax consequences. For people who don't plan during life or don't want to relinquish any ownership interest during life, they can also have that transfer occur at death through their estate plan. I think it should go without saying, but this doesn't register with everyone, that these plans really need to be made during lifetime. And the more time that is available to plan, the more likely it is that the selected strategies will be detailed and effective. The owner's will and revocable trust need to provide clear direction for continuation or the sale of the business. The owner should consider naming a management committee to oversee business operations if they don't have family members who are able or willing to do so. They should also consider funding the estate tax obligation with an insurance, possibly through an irrevocable life insurance trust, which you also hear referred to as an ILIT. If the business is going to be transferred within the family, the plan should provide for transfer of controlling and economic interest in the business and also directly address issues of fairness. I had a client who passed away last year who had no plan in place for the continuation of his business, and as a result, upon his passing, his kids, who had not been at all involved in the business and really had no business experience, had to step in and figure out what to do with the company. This caused a lot of confusion and chaos for the employees of the company, and it caused a lot of the key employees to leave, which caused customers to lose confidence in the company and ultimately take their business elsewhere. As a result of this, when the business was ultimately sold, it was sold for significantly less than it could have been worth if a cohesive management group had been in place. So for sales outside of the family, there are a number of options. An IPO, which obviously is only viable for very large companies. There's a sale to an outside company or individual. When you're structuring a sale, it's really important to consider the tax ramifications of selling stock in the company versus selling the company's assets. The sale of the company will typically be a capital gains event, while the sale of hard assets will typically be taxed as ordinary income. In an asset sale, you need to be aware of the possible double taxation on entities structured as C Corps or on S Corps that have converted from C Corp in the last 10 years. Sales can be structured for cash, for stock, or a combination of the two. Non-compete and consulting agreements with the buyer can also provide for additional value and cash, but the seller should be aware of the tax consequences there. If shares are transferred to the owner's children prior to the sale, proceeds from those gifted shares will pass to the children. And in many cases, the children are in a lower tax bracket than the business owner, so as a result, they would be taxed at the child's lower income tax rate. There's also the option of a sale of the business to partners, co-owners, and employees. In any business with multiple owners, it's very important to consider the 5 Ds. That's death, disability, divorce, departure, and default. The best way to manage these risks is by having a pre-established buy-sell agreement among the co-owners. And you want this type of agreement to be automatically triggered by specific events, those specific events being the 5 Ds. And you want the agreement in an ideal world to be funded with insurance. Not having a buy-sell agreement in place has the potential to cause significant disruption for other owners and can also be a threat to business value. Another option is to establish an employee stock option plan, otherwise known as an ESOP. This can be a really great way to reward loyal employees if owners would like to see them continue in the business. And ESOP is a kind of employee benefit plan, similar in many ways to qualified retirement plans and governed by the same law. ESOPs are funded by the employer, not the employees. The stock is held in trust for the employees meeting minimum service requirements and allocated to the employees based on relative pay or a more level formula. Using an ESOP comes with several tax advantages, which I think is one of the reasons why it's so popular. The largest is that for the owner of a C Corp, proceeds on the gain from sale of stocks to the ESOP can be tax deferred by reinvesting in securities of other domestic companies. If these securities are not sold prior to the owner's death, no capital gains tax is ever due. Bob, you've had a lot of experience with buy-sell agreements. Is there anything you'd like to add here?
You bet, and thank you. First, I think buy-sell agreements can be an excellent tool for succession planning. They help facilitate planned outcomes, whether that's part of the exit strategy or to safeguard against unexpected events like you had mentioned, illness, divorce, or disability. And when thinking about buy-sell agreements, there are two fundamental components of most agreements. There's going to be the funding mechanism and the valuation approach. And as you mentioned, the funding mechanism is often life insurance proceeds. So you want to make sure that the policy is up to date and that it is still adequate for its purpose. And as to the valuation approach, we generally recommend that you use a fair market value standard of value. And ideally, that value would be determined by a third-party appraiser, somebody who is independent and qualified to deliver that opinion of value. And I'd like to share with the audience an example of how this can be so important. So here are the facts. You have two shareholders, a 90% stakeholder, the founder, and a 10% stakeholder, a key employee who's been rewarded for his years of service. And the agreement is structured in such a way that upon the first to die, the company would buy back the stock of the decedent using life insurance proceeds, and if there's a gap in value, promissory notes. The valuation approach in this particular case was book value, and it has been my experience that book value is rarely a good indicator of the fair market value of a company. In this particular case, the 90% stakeholder was the first to die, and at the decedent's date of death, the book value of the company was about $40 million. When estimating the fair market value of the company, it was closer to $65 million. And with the buy-sell agreement in place, the decedent's family really had no flexibility. There was a buy-sell agreement, there was an obligation to sell the stock back to the company, and the valuation would be at book value. And they honored that obligation, and in doing so, effectively left the better part of $25 million on the table. But a nuance that really was missed by a lot of folks was the fact that that $25 million could have been viewed as a gift from the decedent to the 10% stakeholder. And if it were viewed as a gift, the gift taxes alone could have wiped out a good deal of the liquidity that was generated in the buy-sell agreement. So the moral of the story is simply to review the terms, to review them on a regular basis, and to try to anticipate any potential downstream effects. So with that said, let's move on to the next slide. Thank you. So as Holly outlined, one of the dominant paths for transferring ownership of a business is a sale or transfer within a family. And when thinking about some of the business issues that are involved, when looking at a transfer within a family, it's been my experience that a prevalent issue is around control, both in terms of ownership of the company and management of the company. So when thinking about separating ownership from control, first of all, it's a natural tendency for business owners, or for anybody for that matter, to resist giving up control. But at some point, it's simply inevitable. And a common technique that's used, and one we would encourage, is one that allows the owner to retain control but still move wealth out of his or her estate. And that's by recapitalizing the company into voting and non-voting shares, and then gift or sell the non-voting stock while retaining the voting stock. And then a technique that can be coupled with this is to put that voting stock into a trust in the chance that the business owner becomes incapable of managing his or her own affairs. So that's ownership control. Management control and transferring or giving up management control can be an equally challenging issue, especially when ownership stays within the family, but the company is managed by non-family members. Or similarly, when the next generation of owners assume their responsibilities, and some are working in the business and others do not. But in either case, I think the best plan is to ensure that the successors, whoever they may be, have the skill and the competence to effectively run the company. And I think we should all recognize that this can take years of training and development to achieve. The other comment I would make on that is that when all is said and done, clear and honest communication amongst all of the stakeholders will really go a long way towards a smooth transition. Holly, if I can hand it to you for some personal issues.
Sure. I think one of the most important personal issues to consider is if you can afford to give away or sell part of your business, and if so, how much can you afford to part with? We recommend that business owners do cash flow modeling to determine how much they can afford to give away while still maintaining sufficient cash flow to cover their lifestyle. This is something that almost no estate planning attorneys offer, even though they regularly encourage their clients to make large gifts. And it's an area where I think investment advisors and financial planners can be really helpful. I hate to see situations, and I had one of these earlier this year, where a client on paper looked to be very affluent and a liquidity event was coming up, and the estate planning attorney suggested that he give away a huge portion of his interest in the business prior to the sale, and didn't really understand the scope of this person's expenses. They had a really expensive home that they maintain, and they ended up giving away a little more than they could really afford to, and then having to go back to the trust established for the children and work out an arrangement by which some money could come back to them. And you never want to be in that situation. Consider alternative approaches to determine how best to treat heirs who are not involved with the business in a fair manner. Everyone's definition of what is fair is different, and it doesn't always need to mean equal. Private equity or a partial sale to a third party can fund an inheritance for non-participating children. Real estate on which the business is located can be planned for differently than the business itself, and smaller interests can be left in trust for the benefit of those non-participating children. Consider using life insurance to fund an estate tax obligation. Obviously, this is assuming that the estate tax isn't repealed, which has recently been proposed. Also, to the extent that the estate tax remains in effect, be aware of the constraints of the 6166 election if you would like to have the ability to pay the estate tax attributable to your business interests over a number of years. In order to qualify for this election, the business interest must exceed 35% of the owner's adjusted gross estate. So when doing gifting of ownership interest, it's really important to keep this number in mind. If the business owner does qualify for the 6166 election, the tax and interest attributable to the value of that company can be paid over 14 years with interest-only payments for the first 5 years. And the interest rate in the case of that election is really favorable. So we would never want to see someone do aggressive gifting and then inadvertently disqualify themselves for this election. Also, consider a charitable vehicle to manage tax consequences and also instill values across generations. Charitable entities are a really great way to ensure that the next generation continues to work together after the parent is gone. And if you decide to start a new venture, consider building in a gifting structure at the time that new venture is created, meaning establishing voting and non-voting shares at that time. And if your children shared in the prior liquidity event, consider having them actually make contributions into that new entity. Bob, I'll turn it back to you for sale to members outside of the family.
Excellent. So when considering a sale to a third party and thinking about some of the business issues involved, retaining and incentivizing management is critically important. If for no other reason, one of the most significant drivers of value in almost any company is the depth and strength of its management team. And keep in mind, these are also the same people who are most likely to be the ones telling the company's story to prospective buyers. So in preparation for a sale, a critical component is to ensure, to the extent possible, that key employees will be there through the transition. And there are a variety of approaches to consider. There are some fairly simple approaches like retention bonuses or employment agreements, or it can get a little more sophisticated with profit sharing plans and phantom stock, or perhaps direct equity in the company, to name just a few approaches that you might consider to retain and incentivize management. Whatever that approach may be, though, you want to be careful to provide sufficient incentive to retain those employees, but you don't want to create so much of a burden, if you will, on the company that you create a potential roadblock to getting a deal done. A similar thought about retention of key customers, and this is particularly important as well, especially if you have concentrations in one or a few customers or one or a few key contracts. And then I'd also like to note that in the sale process, you will expose your company's information to potential buyers. It's just part of the process. And you should expect that they will sign and honor a confidentiality agreement. But you should also recognize that things can slip in a sale process and information can be divulged. And this is where I would recommend the use of an M&A advisor. Through an M&A advisor and the use of a data room and other controls, they can really help you maintain confidentiality as you're working through the sale of your company. And then as a seller, I would also encourage you to think in terms of only sharing enough information or information in proportion to the credibility of the potential buyer. And as you winnow down the number of potential buyers and get to perhaps the last two or three or the likely buyer, it's an inverse relationship of the amount of information that you're going to want to share. So those are my thoughts on sale to an outside party. Holly, can I turn it back to you?
Thanks, Bob. Many of the personal issues are similar to family transfers, but the primary difference is the management of income tax consequences. As we've already discussed, owners should be aware of the tax ramifications of selling stock in the company versus the company's assets. There are also options available to limit the tax ramifications of a sale. Transfers can be made to a charitable entity prior to the sale, and by doing that, you have both made a charitable contribution, but also any income tax associated with the shares then owned by the charity would be recognized by the charity and thus not taxed. You do have to be aware of UBTI issues there. Tax benefits are also available to the owners of certain qualified small business stock. Qualifying taxpayers may be able to exclude or defer all or a portion of the gain on the sale under various Internal Revenue Code provisions. Other ways to manage income tax consequences are by using vehicles to shift the assets to other taxpayers prior to sale. If shares are transferred to children prior to the sale, the proceeds from those gifted shares would be taxed at the child's level. You may also be able to avoid state income tax consequences by transferring assets to what's known as an incomplete non-grantor trust in a state with beneficial tax provisions. We see people doing this a lot with Delaware trusts. By investing in specialized tax loss harvesting funds prior to the sale of a business, you may be able to generate capital losses that could then be used to offset a portion of the gain from the sale of the business while getting investment performance similar to certain common benchmarks. In some states, you may be able to purchase state tax credits that can essentially discount the amount due to your state taxing authority. I'm in Massachusetts, and this is a pretty popular technique here. Film companies get a lot of state income tax credits, but they're here for a very short period of time, so they're not actually here long enough to use them. So they end up selling them at a discount, and then the purchaser can apply those towards their state tax payments. If you structure your sale as an installment sale with payments and related taxes being due over a number of years, this is a really popular technique this year. This method allows you to wait until your tax return is due to decide whether or not you want to elect installment payment. And since we think there's a high likelihood of tax rates going down, this would allow you to opt into that potential new, more favorable income tax structure if and when tax reform is passed. Bob, I'll turn it back to you.
Great, thank you. So in thinking in terms of transition timeline, this illustration is really here to make the point that a business succession plan is not a one-time event. It's not something that gets documented and put in a binder and put on a shelf, but rather it's a process, and it's an iterative process that over the course of time will be revisited and improved upon and developed. And just like a strategic business plan that a board of directors may be using to guide a company through its growth and performance, the succession plan will guide the owner's planned exit from the business and should, as I mentioned, be reviewed on a regular basis, especially if there's been a change in the family, a change within the company's organization, or perhaps a change in tax law. Next slide, please. When thinking about pre-transition, I am going to largely speak to and focus on sale to a third party, as that is really a prevalent exit strategy today. But many of these concepts will similarly apply to a transfer within the family. But it all begins with planning. And whether you are looking at 2, 3, 4 years out, some steps that you can take well in advance of your planned exit can really help in terms of making for a smooth transition. So, for example, if your intent is to transfer within the family, evaluate the readiness of that next generation of leaders and be honest with yourself. And if they're not ready, implement a plan for their training and development and get those leaders to a point where you're comfortable with the transition, they're comfortable with it, taking on responsibility. And I would really encourage you to gauge your transition timeline according to their readiness. If you're contemplating a management buyout or an ESOP, ask yourself whether the management team is ready, willing, and able to take ownership of the company. And similarly, are the company's earnings sufficient to both support the buyout as well as your future liquidity and cash flow needs? Or if the sale is to a third party, and we think that'll be the likely outcome, will it be a sale of some or all of the company? Quite often today we're seeing, particularly with private equity funds, acquisitions of minority interests in a step one followed by a larger acquisition in a step two. Who might the natural buyer be? Would it be a financial buyer like a private equity fund or a strategic buyer like one of your competitors? And as you are thinking through the planned exit, what about yourself? Will you stay on for a period of time, perhaps through a consulting agreement or an earn-out structure, as that may play into the negotiations and ultimate purchase and sale agreement? I would also encourage you to begin some degree of internal due diligence. You want to anticipate the level of scrutiny that a typical buyer is going to undertake when they conduct their own due diligence. And having had the opportunity to sell a good number of companies and go through the seller side of the equation, I can assure you that buyers will take every opportunity to glean as much information about your company as they can. So getting ahead of the game and preparing yourself will pay dividends down the road. So look at things like your historical financial reporting and ensure that it is fairly recognizing the earnings of the company. You'll want to start to develop financial statement projections with a focus on achievable growth. One of the things that will really help you in the ultimate sale of your company is, as you're presenting those projections, that you're actually hitting them as well along the way. And it would encourage you to begin to look at things like obsolete inventory and aged receivables, simply things that can be taken off the balance sheet in an effort to clean things up. Tighten your operations, your policies, your procedures. These will be important too as transaction is upon you. And bottom line, focus your efforts on what is driving valuation in your industry. And this is where consultation, either with an M&A advisor or a business valuation professional, can really be helpful at that stage of the game. As you start to get a little bit closer and are perhaps wanting to initiate the sale of your business, there are a number of strategic decisions that you can make. So think in terms of 12 to 18 months out from that planned sale. Take a hard look and carefully analyze the current conditions of not only the company, the industry, but kind of where you are. So are you, the owner, ready to embark on the sale of your company? Because you simply need to know it can be demanding and it can be an emotional journey. And look at the company. Is it well capitalized? Is it profitable? Are you commanding a good market share and on a growth trajectory? All of these are important attributes as you position the company for sale. And then look at the industry. What's the size of the industry, the rate of growth? What's the attractiveness of the industry? Again, more important attributes to the value of your enterprise. About a year out from the transaction is when you want to think about assembling your deal team. This is going to be your core group of specialists who are going to work with you through the transaction. And these are also the people that you know you can trust to maintain confidentiality throughout the sale. And typically it's going to be your accountant or tax advisor, legal counsel, an M&A advisor, your banker, and a wealth advisor. Oftentimes, too, it's going to include key members of your management team. This is also the time when you want to be sure to organize your corporate structure, meaning making sure that your books and records are in good order, your policies and procedures are good and tight, and that all of this is readily accessible when buyer due diligence gets underway. Likewise, if at all possible, identify and accelerate the resolution of any outstanding litigation, or if you happen to have environmental issues, mitigating those and trying to put those behind you as well. And then finally, taking a look again at your balance sheet and income statement. As you're presenting your financials, you want to make sure that both in terms of earnings and in terms of assets and liabilities, you have defensible, predictable, and sustainable financial reporting. Next slide, please. So a few additional comments about internal due diligence. And I truly believe this is an important exercise that, if done well, can serve to help reduce transaction risk. And hopefully, throughout your negotiations, you'll be able to then reduce the dollar amount of escrows, limit the warranties that you may need to make, and equally important, shortening the timelines on both closing items and then post-closing items. So when looking at the balance sheet and income statement, which I've mentioned a couple of times now, take a look at the quality of your financial reporting. Are your statements compiled, perhaps reviewed, audited? Depending on the size and the complexity of your company, you really ought to consider having at least 3 years of audited financial statements ready for when you want to go to market. And if you can, try to move non-operating assets out of the business and look at selling off any unnecessary or unproductive assets. I had mentioned valuation metrics a bit ago. Again, I would encourage that as you're conducting internal due diligence, do so with a focus on what's driving valuation in your specific industry and try to focus your efforts on those metrics. In terms of corporate structure, not only locating and organizing those documents, but having at the ready your formation documents, important leases, contracts, anything supporting your copyrights, trademarks, patents, all things that you're going to want to have ready to present to prospective buyers. And then finally, again, I'll reiterate, identify and remove any potential roadblocks to getting a deal done. Typically, once you're in a sale mode, things can happen quickly, and you simply want to be in a position to deal with the speed and the volume of those information requests that undoubtedly are going to come from prospective buyers. So why don't I pause there, and Holly, turn it to you for some thoughts on the transition team.
Thanks, Bob. I have a lot of people come to me and say, I have an advisor who I've been working with for the last 25 years. They helped me create my company. They really understand the ins and outs of my company. I don't think I need anyone else involved in the sale of my company. And I think a lot of times this costs people a lot of money in the long run. In an ideal world, you want a corporate attorney involved. This is counsel who is very familiar with the type of deal you're contemplating. And oftentimes, that long-time trusted attorney doesn't have that experience, but they can partner together. You want a tax attorney and also an accountant, ideally. You may be able to ask your corporate counsel to suggest a tax partner at their firm, and your business or personal accountants can also be beneficial to include in the deal team. An estate planning attorney, please don't let your corporate attorney or that long-time family attorney act in this capacity. It's really a very specialized area of the law, and you're going to save yourself a lot of money in the long term and a lot of hassles and headaches if you bring in a specialist to assist with the estate planning piece of this and to help coordinate this with the transition. An M&A advisor, which Bob has discussed, and an investment banker who can develop, manage, and optimize the results of your business sales. You might also want to bring in someone like me, a wealth strategist, who has experience providing a broad range of analytical and planning services. Something I touched on before was the importance of a cash flow analysis. This isn't something that your attorney or accountant typically would be preparing for you, and frankly, you also wouldn't want them to at the hourly rates that they charge. But someone who can be a sounding board, a facilitator, and a coordinator of the various types of planning, to make sure that what you're doing with the business also coordinates with your long-term intentions as far as planning for your family. A portfolio manager who can help business owners reevaluate their risk tolerance and financial goals post-sale. They can also provide pre-sale some planning options, as we discussed before, such as a way to take your investable assets and invest them to harvest losses for a period of time so that you have a pool of losses that are there to offset gains from the sale. A business transition specialist, someone who's experienced at handling and controlling substantial ownership interests and can really be a second set of eyes and provide you with a lot of guidance and sort of hand-holding through the process. And then lastly, a philanthropic specialist, and this is something that we'll talk about a little more, but later on, this is someone who can help you understand, to the extent that you are charitably inclined, what some of the philanthropic tools are that could help you both to minimize your tax burden, but also to pass along some of your philanthropic ideals to the next generation. So after a transition, you're really not done. There are a number of things that you still have to consider. The ongoing contractual obligations, any deferred interest, personal legacy, philanthropic goals, which we touched on a little bit a moment ago, and we'll get into a little more momentarily. And then if you've decided, if you're not retiring, if you've decided there's something else that you want to do, what is that something else, and how will you structure that with the hopes of minimizing ongoing tax ramifications? Bob, is there anything you'd like to add here?
Yeah, a quick thought. And Holly, I have to say, I love the comment that post-transition, you're really not done, because that is so true. And thinking in terms of if a sale to a third party, for example, there are oftentimes post-closing obligations of the seller. And I made reference to this when we were talking about internal due diligence and preparing for the sale. And oftentimes included in a transaction are going to be escrows or earnouts or consulting agreements. And I just can't emphasize enough the significance of what those post-transaction obligations can mean, both in terms of dollar amounts or timelines that will extend the transitioning owner's tie to the company. So just a quick thought there about post-transaction.
Thanks, Bob. American entrepreneurs as a group rank consistently among the most generous segments of the American population. And so I think it's important that we talk a little bit more about philanthropic giving. There are several different types of giving. Active involvement, which obviously means in a hands-on way getting involved in a charity. And this is something for business owners that are transitioning out of ownership and into more of a retirement type lifestyle, something that's often a very popular thing to do with time, to feel actively involved in a charity that is important to you. There's also direct giving, which is a contribution of cash or other economic interests directly to a charitable institution. Private foundations, which is the creation of an entity that is tax approved by the IRS to give funds to charities. Private foundations get a lot of buzz, but I find in practice very few people end up using these. I generally say if you're not planning to fund it with more than, say, $3 to $5 million, it can be administratively sort of a hassle. A lot of red tape there, sort of costly to operate. Then there are donor-advised funds, which a lot of financial institutions run, which is sort of a more streamlined version of a private foundation. You can accomplish the same things there, but without all of the hassle and red tape. Split interest giving, and of course there are a whole host of customizable philanthropic strategies. I have a client who recently gave a percentage interest in his company to a public charity in which he was really heavily involved. And a year later, the company was sold. And not only did the charity benefit really greatly from the sales transaction, but the client avoided recognition of income on a large portion of that sale. So really everyone won from that. For some clients, some of these forms of giving are far more important than just the income tax benefit. They like this sort of thing because it's a vehicle by which they can get their children working together and instill in their children and future generations family values. It's also a really great way to ensure that kids come together and work cooperatively after a donor is gone. And it can be a really great way to teach values and financial skills to younger generations. Dave, I hope that this has provided our listeners with some strategies for creating a business transition plan and protecting their legacies. I'm going to send it back to you now for questions.
Great. And folks, if you want to ask a question, please go to the GoToWebinar control panel And you might have to click the little triangle to open up the question panel, but go ahead and type it there. And you'll also note while you're there that there is an item for handouts, and if you click to open that one, you can actually grab the PDF of this presentation straight away, so super handy. So let's start with a question for Bob. You, in your comments, talked about assembling the deal team, and you mentioned including an M&A advisor. So tell us a little bit about why a business owner would want to have specifically that M&A advisor as part of the team.
Sure, and I'll respond to that in the context, of course, of selling your company as opposed to a transfer within the family. But when selling a privately held business, every seller ought to know that the marketplace can be a particularly risky place where many times the buyers have much more experience than the sellers do. You know, if it's a private equity firm, for example, they're buying companies all day, every day. This is what they do, as opposed to a seller who it may be a once-in-a-lifetime event for them. And so by engaging an M&A advisor or an investment banker, to put differently, you can really help to level the playing field. That M&A advisor is going to help the seller assemble the information necessary for that offering package. They'll communicate the value that your company represents to prospective buyers. They'll also help create a competitive bidding process. And for sellers looking to optimize transaction proceeds, creating that competitive bidding process is critically important. And then they'll help to negotiate, structure, and close a transaction that meets the specific seller's needs. And so, in a nutshell, I strongly advise people to work through an M&A advisor when selling their company.
You remind me of a quote that one of my venture investors in one of my software companies along the line, he was always saying it takes 2 deals to get one. I like your point about competition. Let me throw this out there. I'm not sure which one of the 3 of you would be best to answer it, so jump in. We talked about some statistics related to older business owners, baby boomers, and succession planning. Are there other trends that you're seeing in this area that you can share with us?
This is Bob. I'll take that one. A trend that we are seeing in particular around succession planning is having to do with the types of exit strategies that we're seeing. It's an ever-evolving place, but what we are seeing is that business owners today expect, only about 1 out of 5 business owners today, expect that the ownership of their company is going to transfer to the next generation, which, put another way, 4 out of 5 business owners today expect that they'll be selling their companies. And if you were to have asked me something similar a generation ago, it would have been double that 40% of companies transitioning within the family, fewer being sold. And what's really interesting is it's not that younger people today do not want to own and run companies. They do, and if we're referring specifically to millennials, they tend to have this entrepreneurial spirit that says, I want to run my own company. And so just from a trending standpoint, we're seeing more and more business owners selling and more younger business owners starting up and running their own companies.
Excellent. I see, by the way, we're getting far more questions than we're going to be able to answer here between now and the top of the hour. So, folks, please make note if you're looking at your computer screen. Karen, Holly, and Bob have been kind enough to share their phone numbers and their email addresses. I'm going to suggest that there's the opportunity to reach out after we're done with today's call. So anything we don't get addressed, please make the connection. So I have an interesting one here that probably is not uncommon in family businesses. I have 3 children, but only my daughter is working in the business. What advice would you have about the things I should be thinking about when it comes to the transfer of my business to her, or maybe I'm being too specific saying just to her. So what would your thoughts be?
I'll take that one. First, the business owner needs to decide what they think is equitable, and this answer is really different for everyone. Do they want all of their children to share in the business equally, but for the daughter to be rewarded with additional wages from the company? Or do they want the daughter to become the sole owner of the company? And if so, do they want to make some sort of offsetting gift of other assets to the non-participating children? The first and sort of easiest thing they can do is separate the ownership from control. Do they intend for the children to share ownership of the company while giving the daughter who's involved the management control? And if not, how will they equalize what they pass to the other children versus the value of the company that's going to the daughter? They can consider separating, as I mentioned before, the business from the real estate on which it sits. The daughter could receive a larger part of the business, but if everyone were to share equally in the real estate, they would benefit every time the business made a rental payment on that real estate. They can also consider, and this is something that's really growing in popularity, using an outside investor or private equity firm to free up funds to give to the non-participating children. For the parent who feels like giving everyone an equal dollar amount is the right thing to do, this is becoming a really popular technique. So obviously a lot of options here, but first and foremost, they need to figure out what treating the children equitably means to them.
That makes great sense. I think we have time for one last question, and this is one that I think probably everybody is interested in. Once I decide to pull the trigger to sell my company, how long will it take to complete the sale?
I think, Dave, I think that may be a good one for me. So in terms of how long will it take to complete the sale, honestly, a big driver in answering that is how well prepared you are going into the sale. So we talked a bit about pre-sale due diligence and having the house in order, so to speak. That will help accelerate a timeline. But generally, one can think in terms of perhaps 12 to 18 months to prepare for a sale, and then perhaps another 6 to 12 months to actually take a company to market, identify buyers, negotiate with buyers, and get to closing. And then I just want to mention that from a timeline standpoint, don't overlook post-sale obligations, and that can easily run 12, 24 months, depending on facts and circumstances. So there you have it.
That sounds like a good place to leave it, although I could see that we could probably come back every single Friday for the rest of the year and keep this conversation going. So that's a little bit on transitioning ownership of your business. Thanks, Karen, Holly, and Bob, for your comments and your thoughts.
Thank you, Dave.
Hey, folks, you can thank you. And for everyone listening, remember you can access, or you can grab the PDF right now off of the GoToWebinar control panel, but this is also recorded audio integrated with the slides, and you can access those past recordings at vistage.com/webinars. Typically, the webinar is posted the Wednesday following these Friday events, but you'll find the entire catalog there, and then this one soon. We're also going to be right back, boom, boom, with 2 webinars, one next Friday. That's going to be May 12th at our standard time, 10 a.m. Pacific, 1 p.m. Eastern. We're going to talk about Market Smarter with Next Generation Competitive Analysis, and our guest is going to be Ben Landers. And then the following Friday, May 19th, again, same times, we're going to be talking Culture by Design, Not Default. And Kathleen Quinn Votoff, who's been our guest in the past, will be with us. So on behalf of Karen Reynolds-Sharkey, Holly Swan, and Bob Kitzman, and the entire team at Vistage Worldwide, I'm Dave Nelson. Thank you for joining us. We'll see you again at the next webinar.